Turning a modest salary into a fortune may seem daunting, but with the right strategies and investments, it is achievable. Imagine transforming your $2,000 monthly salary into a multi-million-dollar portfolio through smart financial decisions and disciplined investing. Whether you play it safe, don't mind a bit of market roller coaster, or are keen on investing in personal growth, several paths can lead you to wealth. In this video, we'll explore 4 key areas: certificates of deposit, CDs, the stock market, small-cap mutual funds, and investing in yourself. Each section provides detailed steps and insights to help you on your journey from a modest salary to significant wealth. Don't forget, a list of financial instruments is in the description to help you achieve your results. But before you start exploring these opportunities, watch this video carefully. Investing in CDs is a straightforward and secure way to grow your savings. Here's a friendly and detailed guide to help you navigate the process. When you're considering where to open your CD, it's important to focus on reputable U.S. banks and financial institutions that offer competitive interest rates and have strong credit ratings. A higher credit rating indicates that the institution is financially stable, which is crucial for ensuring the safety of your investment. Take the time to research and compare different banks, reading customer reviews to gauge their reliability and the quality of service they provide. By comparing interest rates across these institutions, you can find the best deal that aligns with your financial objectives and helps you maximize your returns. CDs come with various options for tenures, ranging from short-term to long-term durations. Typically, longer terms and larger deposit amounts offer higher interest rates. When deciding on the tenure of your CD, consider your financial goals and liquidity needs. If you anticipate needing access to your funds in the near future, opting for a shorter term might be more suitable. On the other hand, if you're looking to maximize your earnings over time and can afford to lock your funds away for a longer period, a longer-term CD could be beneficial. Opening a CD account is generally a straightforward process. You'll need to gather some basic documents such as identification proof and a recent photograph. Many banks now offer the convenience of opening a CD account online, which simplifies the process significantly. After submitting your documentation, you can make your initial deposit. The bank will issue a CD receipt or certificate that outlines the terms of your investment, including the interest rate, maturity date, and any penalties that may apply for early withdrawal. Once your CD account is opened, it's important to carefully review the CD statement provided by the bank. This statement contains critical details about your investment, such as the exact interest rate applied, the maturity date when your funds will be available for withdrawal without penalty, and any terms related to early withdrawal penalties. Understanding these terms ensures that you're fully aware of the conditions of your investment and can avoid any unexpected surprises down the road. When your CD matures, you'll have several options for what to do with your funds. You can choose to withdraw the principal amount along with the accumulated interest earned, providing you with immediate access to your funds. Alternatively, if you don't need the funds right away and want to continue growing your savings, you can opt to reinvest the funds into a new CD. Reinvesting allows you to continue earning interest on your initial investment, potentially at a new interest rate based on current market conditions and your chosen tenure. CDs are great for risk-averse investors looking for stability and predictable returns. However, remember that the returns on CDs might not always outpace inflation. This means that while your principal is secure, the purchasing power of your returns might decrease over time due to inflation. To make the most of your CD investments, consider exploring additional financial deposits and investment strategies such as diversifying your portfolio with mutual funds, stocks, or bonds. Each of these options comes with its own set of risks and rewards, so it's crucial to do your research and possibly consult a financial advisor to tailor your investment strategy to your specific goals and risk tolerance. Investing in the stock market presents exciting opportunities for higher returns, but it also requires careful planning and vigilance due to its inherent risks. To embark on this journey confidently, it's crucial to follow a well-thought-out strategy and stay informed about market dynamics. Here's a friendly and easy-to-understand guide to help you start your stock market investment. Firstly, opening a brokerage account is your gateway to the stock market. Choose a reputable firm known for excellent customer service and a user-friendly trading platform. This ensures that managing your investments is smooth and hassle-free right from the start. Research plays a pivotal role in stock market investing. Take the time to study companies with robust fundamentals and growth potential. Look into their financial health, management team quality, market position, and industry trends. Useful tools like financial news websites, stock market analyses, and reports from your brokerage can provide valuable insights. For beginners, focusing on well-established companies with a track record of steady growth can be a prudent strategy to mitigate initial risks. Selecting the right investment strategy is key. Depending on your financial goals, risk tolerance, and investment horizon, consider strategies like value investing or growth investing. Value investing involves identifying undervalued stocks that have the potential to increase in value over time, while growth investing focuses on companies expected to grow at an above-average rate compared to others in their sector. Once you've identified promising stocks, place your buy or sell orders through your brokerage's trading platform. You have the flexibility to choose between market orders, which execute immediately at the current market price, and limit orders, which execute only when the stock reaches a specified price. This flexibility allows you to tailor your trading approach to your specific preferences and goals. Monitoring your portfolio regularly is essential in the dynamic stock market environment. Keep track of the performance of your investments and be prepared to make adjustments as needed. This could involve selling stocks that are underperforming, rebalancing your portfolio to maintain your desired asset allocation, or reinvesting dividends to further grow your investments. Investing in the stock market can be both rewarding and challenging. By following these steps and staying informed about market trends and developments, you can make informed decisions that align with your financial objectives. Remember, patience and diligence are key virtues in navigating the stock market to achieve long-term financial growth and success. Investing in small-cap mutual funds can be a thrilling avenue for investors seeking higher returns, albeit with heightened volatility. Small-cap funds focus on companies with smaller market capitalizations, which often possess significant growth potential. Here's a detailed guide on how to effectively invest in small-cap mutual funds. Choosing a reputable asset management company, AMC, is paramount. Look for firms with a proven track record in effectively managing funds and delivering consistent returns. Assess their past performance across various market cycles, evaluate the expertise of their fund managers, and examine the range of funds they offer. This ensures you partner with a reliable AMC capable of navigating the complexities of the market effectively. Before diving into investments, define your investment goals clearly. Assess your risk tolerance, financial objectives, and investment horizon. Small-cap funds can yield higher returns, but are also subject to greater market volatility. Understanding your comfort level with risks helps in selecting a fund that aligns with your goals and personal financial strategy. Analyze the fund's portfolio comprehensively to understand its investment strategy. Examine the fund's sector allocation to assess its exposure across different industries. Evaluate its holdings and the diversity of its investments to gauge its risk management approach. Reviewing the fund's performance over various market conditions provides insights into its stability and growth potential. Consistent positive performance over time indicates a well-managed fund capable of weathering market fluctuations. Choose your investment method based on your financial strategy. You can invest in small-cap mutual funds through a lump sum or a systematic investment plan, SIP. A lump sum involves investing a significant amount at once, whereas SIPs allow you to invest smaller amounts regularly. SIPs are advantageous for averaging out the purchase cost over time and mitigating the impact of market volatility on your investments. Regularly monitor your investment to track its performance closely. Monitor the fund's net asset value, NAV, stay updated with fund manager commentaries, and keep abreast of any changes in its holdings. Monitoring helps you stay informed about the progress of your investment and enables you to make timely adjustments to your strategy if needed. If the fund consistently underperforms or deviates from its stated investment approach, consider reevaluating your investment strategy to ensure it aligns with your investment goals. Investing in small-cap mutual funds presents significant growth opportunities with careful planning and proactive monitoring. By selecting a reputable AMC, defining clear investment objectives, analyzing the fund's portfolio, and staying vigilant in monitoring its performance, you can make informed decisions that maximize your investment potential. Happy investing! Investing in yourself is a powerful commitment that brings personal growth expanded career opportunities, and the potential for higher earnings. Here are some friendly and effective ways to invest in your personal and professional development. Firstly, pursue education and training. Continuously enhancing your skills and knowledge keeps you competitive in your field. This could mean pursuing formal education, like degrees and certifications, or engaging in informal learning through online courses, workshops, and seminars. Staying updated with industry trends not only boosts your expertise, but also opens doors to new career paths and advancements. Secondly, attend conferences and workshops. These events are gold mines for networking and learning. Connecting with industry experts, peers, and potential mentors offers fresh insights into the latest trends, technologies, and best practices. It's a chance to broaden your perspective, gain inspiration, and stay at the forefront of your profession. Thirdly, read regularly. Delving into books and articles relevant to your interests and professional field provides deeper knowledge, case studies, and expert viewpoints, whether it's industry-specific content or broader personal development topics. Regular reading sharpens your critical thinking, fosters creativity, and hones your problem-solving skills. Fourthly, invest in your health. Prioritize your well-being through healthy habits like regular exercise, meditation, and maintaining a balanced diet. Physical fitness not only improves health but also reduces stress and boosts energy levels. Meditation and mindfulness practices enhance focus, reduce anxiety, and build emotional resilience, ensuring you're mentally prepared to tackle challenges and seize opportunities. Lastly, seek mentorship or coaching. Having a mentor or coach provides invaluable guidance and support in achieving your goals. They offer personalized advice, constructive feedback, and encouragement tailored to your aspirations. Regular interactions with a mentor help navigate obstacles, set achievable milestones, and develop strategies for success, accelerating your growth and maximizing your potential. Investing in yourself isn't just about acquiring skills, it's about fostering a mindset of continuous improvement and self-discovery. By embracing these strategies, education, networking, reading, health, and mentorship, you invest in a brighter future for yourself. Start today and watch how these investments enrich your life and career journey. Investing in yourself is a continuous journey that pays dividends in both personal satisfaction and professional success. By pursuing education, attending conferences, reading regularly, maintaining good health, and seeking mentorship, you can unlock your potential and achieve your dreams. Turning a $2,000 monthly salary into millions requires a combination of smart financial decisions, strategic investments, and personal growth. Whether you choose the safety of CDs, the potential of the stock market, the growth of small-cap mutual funds, or investing in yourself, each path offers unique opportunities and challenges. By diversifying your investments and continuously learning, you can set yourself on the path to financial independence and wealth. Investing in real estate provides a concrete pathway to building wealth over time by capitalizing on rental income and property appreciation. Here's a detailed guide on how to effectively invest in real estate. Start with researching local markets to identify promising opportunities. Look for properties in growing areas where there's a potential for value appreciation over the years. Factors such as economic growth, infrastructure development, and demographic trends can influence property values positively. When choosing a property, consider factors like rental yield and management costs. Residential properties typically offer stable rental income, while commercial properties may yield higher returns but require different management approaches. Assess which type of property aligns best with your investment goals and financial capacity. Financing your real estate investment is crucial. Explore mortgage options and financing solutions to leverage your initial investment. Understand interest rates, loan terms, and financing conditions to make informed decisions that suit your budget and investment strategy effectively. Effective property management is essential for maximizing returns. Whether you manage the property yourself or hire professionals, efficient management ensures consistent income and preserves the property's value. Building positive relationships with tenants, addressing maintenance properly, and staying proactive in property upkeep are key aspects of successful property management. Stay informed about market trends and economic indicators that could impact property values. Monitor changes in regulations, shifts in local economies, and broader market trends affecting real estate. Being aware allows you to adapt your investment strategy accordingly and capitalize on opportunities while mitigating risks. Real estate investments offer stability and potential long-term growth. Integrating real estate into your investment portfolio diversifies your assets and creates a path towards financial independence. It's a rewarding journey that combines financial strategy with the satisfaction of owning tangible assets that can appreciate in value over time. By following these steps, researching local markets, selecting properties wisely, securing optimal financing, managing properties effectively, and staying informed about market dynamics, you can build a robust real estate investment portfolio that generates steady income and capital appreciation over the years. Happy investing! Thank you for watching, and don't forget to like, share, and subscribe for more financial tips and strategies.